Ladies and gentlemen, welcome to this discussion on the future of sustainability in global capital markets. I'm Richard Hopkin. I am head of fixed income at AFME, and as many of you know, I spend most of my time focusing there on our securitization work. But we're going to have this slightly more general discussion to kick off this event, and I'm delighted to be joined today by Dr. Richard Mattison, who is president of S&P Global Sustainable One and CEO of S&P Global True Cost. Now, S&P Global Sustainable One is the single source of intelligence on sustainability, and S&P Global True Cost assesses and prices risks relating to climate change, water, pollution, and natural resource constraints. Richard is a very distinguished expert in sustainable finance, and over the last 20 years, he's advised various UN bodies, governments, financial institutions, companies, and NGOs on how to integrate ESG, climate change, and natural capital analysis into their decision-making. He's been a member of many high-level bodies, including the EU High-Level Expert Group on Sustainable Finance, providing key recommendations for the Sustainable Finance Action Plan. He is chair of the Future of the Sustainable Data Alliance Data Council, a member of the Global Advisory Council of the Oxford Smith School Stranded Assets Programme, and various other bodies. By way of background, he has a PhD in neuroscience from the University of Edinburgh and is an honorary fellow of the Royal Society of Art. So, Richard, you're a true Renaissance man there, seriously. So I'm very much looking forward to our discussion. But I know we've got about 10 or 15 minutes to chat, and we have lots of things to discuss. But before we sort of launch into some questions, perhaps you'd like to make some introductory observations to help our delegates today kind of set the scene for the later discussions.
Yeah, thank you, Richard. It's a really great pleasure to be here today. Very excited about the discussions this afternoon. So just a little bit of background on S&P Global Sustainable One. This is a new group that we've set up at S&P Global. We set this up at the start of the year, actually. It's about 500 people. It sits at the heart of S&P Global. It services all 4 divisions. So S&P Global Ratings, but also our index business, S&P Dow Jones Indices, our data business, S&P Global Market Intelligence, and our energy analysis business, which is S&P Global Platts. Really, the reason why we did this was that we actually recognized that sustainability topics, and in particular things like climate change and more broadly ESG, are really critical to the type of analysis that S&P Global is providing to markets today. So we have, for example, over 700 billion data points on climate risk. We have coverage of about 15,000 companies on ESG, about 110,000 companies on climate risk and other topics. And so our job is to really provide all of that wealth of intelligence to the marketplace to ensure that we are making the right decisions about allocating capital and driving sustainable outcomes. And so the information is made available to all of the 4 divisions of S&P Global, including S&P Global Ratings. And that is incorporated, obviously, in the context of credit ratings, and more widely available to the marketplace as well. And it drives a number of different index products, such as the Paris-aligned Climate Transition Index. So I'm really excited to be here today because for us, sustainability, and in particular now in the run-up to the climate change conference at Glasgow, COP26, this is really a pivotal moment for the world, for world leaders and for capital markets, because the majority of capital required for our transition to a low carbon economy is going to be provided by, the private market, if you like. So really excited for the discussion today. Really looking forward to it.
Sure. No, that's very interesting. I mean, very interesting to hear, of course, about the other divisions of S&P Global, because I, being a humble securitization practitioner, just think, when I hear the words S&P, I think rating agency, but of course, you're a much, much bigger company than that. So it's really interesting to hear how you're integrating this analysis across the whole group. And I completely agree with you about the need for funding for this transition. And part of AFME's advocacy on securitization is very much saying that, you know, securitization has got to be one of the pillars to help us find all this capital we need to mobilize to get this done. Let's talk a little bit about what needs to be done then. You can't open a paper any morning now without hearing discussion about climate change and net zero. But can you tell us a little bit exactly what net zero means? It's a very glib phrase, you know, particularly politicians like to throw around. So can you tell us a little bit what it actually means and how companies are beginning to address it in their plans? It's a difficult choice, I think, for all of us, because, you know, there's some balancing to be done, isn't there?
Yeah, I mean, net zero, 5 years ago, that term didn't really exist, actually. It was more called carbon neutral, actually. So net zero essentially means that if you're a company, for example, you should be reducing your emissions and in alignment with the best kind of scientific pathway, if you like, for your sector. You should be reducing your emissions to the greatest extent possible. And then for the part that is, you know, irreducible at that current moment in time, you should be participating in ways to remove carbon from the atmosphere in some way. So that can be through offsetting projects, sequestration projects, carbon removal and storage, and various other things that might be available at various points in time in the future. And so the general ambition is that we should be halving our emissions by 2030 and effectively net zero by 2050. And so you see most of the governments of the world have really signed up to some form of net zero commitment. In China, it's actually 3060 is what they're aiming for. And Saudi Arabia is 2060 as well for their net zero targets, which they just announced over the weekend. And many companies, over 4,000 companies, have committed to net zero now. And indeed, frankly, the majority of the finance sector, which is quite remarkable. So the majority of the finance sector, under an initiative led by Marke, has signed up to something called the Glasgow Financial Alliance for Net Zero. It's now close to $100 trillion of assets under management signed up to that. And in particular for the finance sector, what that means is that within 1 year, they will have to disclose pretty rigid and very clear quantitative commitments to net zero, not just a 2050 target, but actually how are you going to shift assets by 2025 and 2030? And so I think net zero is one of those things that actually is sort of both a huge growth opportunity for the world, but also, you know, people are scratching their heads right now. How do you actually, you know, get on the right plan? What does a transition actually look like? How do we ensure that we bring everyone along at the same pace, that we don't simply divest, for example, and someone else picks up the fossil fuel heavy assets? These are all issues that many big financial services firms, banks, asset managers, pension funds are all struggling with right now. But net zero is certainly top of mind as we head towards the Glasgow Climate Conference.
Sure. I mean, certainly the whole ESG agenda is taking up, you know, an increasing amount of, you know, my time as an AFME official and that of my colleagues. So I think you're right that the financial sector have really got their teeth stuck into this. Do you think, though, there is enough ambition? I think, you know, you were describing a very strong momentum there from countries and from, you know, financial institutions. But do you think we are moving fast enough? Do you think there's more we could do? You know, are we being sufficiently ambitious?
Yeah, I mean, I think there's a lofty long-term ambition, but let me give you an analogy, right? I think basically what we have at present is the equivalent of, you know, the Footsie all share disclosing, you know, 30-year, 20-year revenue targets, but not giving you any information about, you know, what their financial prospects look like over the next year or two out to 2025, or any details about the strategy as to how they're going to achieve their 2050 revenue targets. And so it's kind of an unusual situation, actually, because normally markets are quite myopic. They're quite used to kind of short-term information, and getting the long-term information, is very rarely available. And so actually, this is the complete reverse. We have a lot of information about long-term transformation that will be required. Oil and gas major companies have described what their businesses are roughly going to look like in 2050. But actually, getting a bit closer to 2025, 2030, these are key critical milestones. So, in a sense, we've plotted the course. Sorry, we've got the destination plotted in the GPS, but we actually haven't got the milestones, the way leaves, the specific details about how to get there, the route map. So I think that is where we need more ambition. Because quite frankly, by 2050, none of the management of the companies today will still be in those positions. And so, really we need to kind of make sure that we do have a genuine shift today. There are, issues associated with things like greenwashing today, and, labeling of funds or loans in ways that may not be that transparent. I know that there are regulations being brought forward by a number of different jurisdictions across the world to address that. But really, it's the nearer term ambition that we believe needs to be raised if we're to be on the right trajectory towards net zero. It's a pretty ambitious target. It's going to require a lot of collaborative effort and a lot of financing and a lot of smart people collaborating together. But we really need more details about the nearer term. That's our perspective from S&P Global.
Sure. So the first few steps are perhaps going to be the hardest to take.
Yes, exactly. Yeah.
Fair enough. Good. Look, I'm conscious of the time, so let's. I know there's a lot we want to cover. Let's drill down into the detail a little bit more. Then, can you tell us a little bit about how S&P Global analyzes climate-related risk? How do you actually go about it? How do you? I know how to analyze a securitization deal, but I don't know how to analyze climate-related risk.
Yeah, it's interesting. It's kind of, a lot of companies will tell you what their CO2 emissions are, but that's pretty hard to translate that into something that actually really is meaningful in the context of whether you want to finance that business or not. And so that's really what we do. We form a bridge from a data perspective and an analytical perspective between the basic disclosures made by companies and what that actually means in a financial context. And so let me give you a couple of examples. We break climate risk down into transition risk, which is what are the risks associated with, say, getting to net zero? And then on the flip side, the physical risk, because frankly, we face two pathways. One is a smooth and stable transition towards a net zero future. The other is a highly volatile, nonlinear, disruptive world where we will face a lot of, natural catastrophes and disasters and, the physical impacts of climate change and many other geopolitical issues caused by that, such as mass migration. So we face these two pathways. We need to analyze these two pathways, and we need to kind of analyze them at the same time, essentially. So on the transition risk side, we analyze things like, what is the impact of carbon pricing? Carbon pricing, carbon taxes, carbon trading schemes, those types of things. We constantly monitor 45 jurisdictions. 25% of the world already has a carbon price. So we're monitoring that very carefully. And then we're looking out to the future. If governments actually follow through in their commitments, what would the effective carbon prices look like in those jurisdictions were they to be on the right path? And by our analysis, by 2025, you could see an impact on profitability of up to 13% for the S&P 1200 companies. And then on the other side, physical risk, we analyze 7 major hazards. And we look at 110,000 companies, but we look at about 3 million specific assets owned by those companies, which we've mapped to, we've geolocated those assets. And we've layered on top of that climate models. So we can tell you the likely impact of a flood, drought, heat wave, cold wave, rising sea levels, those, hurricanes, those types of, natural hazards that could impact the value of an asset. And we've assessed that for 3 million assets owned by 110,000 companies. And so that is data that is used to really appraise risk by ourselves, quite frankly, but also by the market more broadly. And so we sort of look, broadly speaking, at transition and physical risk or adaptation. And those are the ways in which we look at the market, if you like.
Okay, very interesting. Yeah, it's a whole new discipline, isn't it? Really, 10 years ago, maybe this sort of approach existed, but probably in a very sort of small area. But it's becoming far more sort of widespread now.
Yeah, we've invested a lot actually in this space because really we believe that you need better information to allocate capital. So,
Right.
if you're financing a green bond, for example, you should probably make sure that where you're putting wind farms or efficient data center technology or whatever isn't going to be subject to natural hazards in the future.
Yeah.
And you should probably make sure that what you're financing is, you're clearly identifying where it is on the spectrum of green as well. Right. And those are the types of things that we do, for sure.
Right. Right. So would you say that the information you're gathering then is useful not just for mitigation, but also for adaptation?
Yes, definitely.
To climate risks. Yeah. So, because these are the two kind of main responses that get discussed, aren't they?
Yeah, that's right. And often people talk about the cost of transition. Is it really worth it? We're going to have to spend a lot of money on this. We're going to have to replace all our boilers, and we're going to have to drive electric vehicles and, decarbonize the electricity grid. And it's going to cost an awful lot of money. And actually, the truth is we don't face a situation where we either have, a transition cost or business as usual. We face a situation where we have a transition cost or the costs of the catastrophic climate change that we'll see over time. And so our job really is to analyze the difference between those two things, and really look at how effective the interventions and the financing of those interventions are. So we do things like a lot of loan book assessments. We do assessments of company issuances, all of those types of things that are very specific types of analysis in the marketplace today. Because really we feel that in the process of allocating capital, you do need to make sure we have this new type of information available to both issuers and those financing those projects or companies.
Sure. Let me, I'm conscious of the time again. Maybe we should sort of wrap up with this last question, and I'm going to, I hope you don't mind if I just probe you a little bit. You use the word catastrophic there. Now, I'm not expecting S&P staff to be, blocking the M25 anytime soon, and I'm sure that you have no intentions of doing that. But do you think there is a little bit of a danger here that everybody's getting a little bit too carried away? And is there a danger of groupthink? When we were preparing yesterday, I point to the example to you of diesel cars. 20 years ago, diesel cars were the great solution to reducing carbon emissions because diesel engines don't produce carbon dioxide. And now, of course, we realize they may not do that, but they produce lots of other carcinogens which are killing people. I mean, carbon dioxide isn't actually poisonous, but so just to be devil's advocate for a moment, do you think there are dangers in all this effort, in particular groupthink? Do you think it's too easy? Has it been too easy to build all this consensus in the financial community that you talked about earlier, the Glasgow Alliance and so on? Everybody's like jumping. I hesitate to use the phrase jumping on the bandwagon, but as a just to test you a little bit on that, what's your response to that?
Yeah, I mean, I think there are areas where we need to watch for a bit of groupthink. I know many are actually getting quite concerned about greenwashing, quite frankly, because can every fund be a green fund or an ESG fund? Is that actually possible? 50% of inflows to ETFs in Europe were ESG, but is that true? Are we actually genuinely making a real world difference with that financing, or are we labeling things? And so I think, I'm not entirely sure that this is happening at a grand scale on an intentional basis. I do think we need a bit more rigor about, really being careful about using terminology and carefully defining what we mean by green financing, ensuring that, when we're calling something a green bond, it is financing some real world outcomes, and ensuring that, when you're thinking about how you're assessing a loan book, a loan portfolio overall, if you like, then you're really being careful about understanding what is green, what is not. You can't call everything green, and nobody would expect that. That's the point. So when you say 50% is ESG, is 50% of the world green? Well, no, we've got a long way to go. So there is a sense of unease, I would say, around some of the described scale of what is happening in terms of the flow of capital, and I think we probably need a little more rigor, and that's something we're looking at very closely. We're working very closely with regulators on that to try and provide more evidence and data sets about what we believe is actually happening, because really at the end of the day, we have to measure real world outcomes. It's not just moving money around, and so I think otherwise we'll fall into some of the traps we landed in before. And so we have to present really clear information on risk. We have to actually be very clear about what we're defining as being green financing or sustainable financing or whatever it is, and what isn't. And there's no shame in just having a mainstream fund. But we do think that there is, if people, if the world really wants to be on that net zero trajectory, we do need that scaled approach to capital allocation. And capital markets do have an opportunity to do that. Just to give you an example, we're really struggling to, the countries of the world are struggling to raise $100 billion fund. But there is one climate fund that is $43 billion, which is the government pension fund of Japan's low carbon index that we run for them. So capital markets can operate at scale, can provide the financing, providing the rules are clear, the definitions are clear, and the opportunity is there, obviously. So we're very excited by the future. There are some risks, but I think we will overcome those in short order.
Great. Well, thank you, Richard. I think that sets the scene perfectly for our next discussion on regulations, which are, as you say, absolutely key. But unfortunately, we'll have to leave it there. Look, I would love to continue this conversation. I could talk to you for hours. It's been really instructive for me, and thank you so much for joining us today. It's been a real pleasure and hugely informative. So thank you.
Thank you so much, Richard. It's been a great pleasure from my perspective as well. Thank you so much.
Great.